What's up, everybody? Welcome back to the channel. If you guys are new, welcome in. My name is Gavin, or Paid by Stocks. In today's video, we're going to be going over everything you need to know about options trading, aka Options Trading 101. This is going to be the complete basics and kind of what you need to implement to get better at trading or to even understand the market. By the end of this video, you'll have a solid understanding of how options trading works. Let's get started. So what will we be covering? In today's video, we're going to be covering what is trading / options, why you should trade options or why you shouldn't trade options, discretionary versus systematic trading styles, how to find your edge, indicators plus technical analysis, brokers, terms and definitions, Greeks, implied volatility, and your strategy, of course. First, let's cover the basics of trading. Trading is essentially buying and selling financial instruments like stocks, bonds, or in this case, options, in the hopes of making profit. You might already be familiar with stock trading, where you buy a stock at one price and sell at a higher price. Now, options are a little bit different. They are contracts that give you the right but not the obligation to buy or sell an underlying asset at a specific price within a certain time frame. So I know that sounds a little bit complicated, but that's like the textbook definition, I would say. I don't know how or what you would want to call it, but that's how we're gonna say it. The simple way I can put it is, imagine you have the option to buy a stock for $100 in 1 month, but you think it's gonna go up to 120. You pay a small fee called the premium for that right, and if the stock goes up, you make money. If it goes down, you don't lose much as if you had just bought the stock. So options give you the choice to buy or sell something at a set price in the future without the pressure of owning it right now. And it's like making a bet on whether the price of something will go up or down. So why should you care about options? Well, options can be a powerful tool, and options are a great way to trade because they offer flexibility, lower costs, and high profit potential. So one of the key options, or one of the main reasons people trade options, is leverage. Options let you control more shares with less money, so you can make bigger profits with a smaller investment. Flexibility. You can use options in many different market conditions, whether the market is going up, down, or staying flat. Unlike regular stock trading, where you can only buy low and sell high. Another important reason people like to trade options is because of the limited risk behind it. When you buy options, the most you can lose is what you paid for them, making it a safer way to trade compared to buying stocks. Another key concept that makes options is the profit from volatility. Options let you profit from market swings even if you don't know which way the market will move. So, the ability to use a small amount of capital to control a large position and profit from small market moves is one of the biggest reasons that traders use options. Now, options isn't for everybody, and this is why I recommend that you choose your market. And we have 3 others listed here as crypto, futures, and stocks. Crypto trading focuses on digital currencies like Bitcoin. It's highly volatile, offering a big profit potential but high risk. Great for those who enjoy fast-moving markets. Futures let you trade assets like oil or indexes with leverage. They're good for speculating on price moves but require strong risk management. Stock trading involves buying shares of a company. It's stable and beginner friendly, ideal for long-term growth or steady returns. So it's all up to you as a trader and how you choose to trade. If you are a higher risk, higher reward type of person, options trading might be for you. Now, how do you trade options? Well, let's go over this. Options gives you the right but not the obligation to buy or sell an asset at a specific price. So, understand that options let you control more with less capital but come with higher risk. Proper education, risk management, and practice are crucial before diving into options trading. So, Calls, you profit if the stock price goes up and it's ideal for bullish predictions. And puts, you profit if the stock goes down and it's better for bearish prediction. So discretionary versus systematic trading styles. So discretionary trading is when you use your intuition, experience, and judgment to make decisions. You might decide based on market news, price action, and or gut feeling. Systematic trading, on the other hand, is when you use a set of rules, algorithms, or systems to guide your trades. This approach removes the emotional aspect of trading. What I like to do is the best of both worlds. Use systematic rules to identify potential setups like an alert when moving averages cross, and apply discretionary judgment to decide which trades to take based on context, such as skipping trades during high impact news releases. This hybrid approach helps you stay disciplined with a plan while allowing the flexibility to adapt to market changes. It's a balance between science and art in trading. The reason I point this out is because systematic trading allows you to have a system and stay consistent with your trades, while the discretionary side allows you to adapt to new markets or even unexpected market conditions. What is edge? Finding edge is about finding something that gives you an advantage over other traders. This could be strategy that works well in certain market conditions, or maybe you're really good at reading charts. An edge in trading is something that gives you a better chance of making profitable trades, like a specific strategy, pattern, or a tool. It's important because it helps you make consistent profits over time and reduces the risks of just guessing in the market. For new traders, finding your edge means testing different strategies such as trend following, breakout trading, or scalping, and figuring out which one works best for you. Using tools like moving averages, RSI, or support and resistance key levels can help you identify opportunities. Journaling is also crucial as it allows you to track your trades, emotions, and mistakes, helping you spot patterns and refine your strategy. Over time, as you practice, learn from your journal, and adapt to the market, you'll develop an edge that gives you a more predictable and confident approach to trading. So, an edge is basically the personality of your trades. How to find your edge. Trend following. Trade with the market's direction by using tools like moving averages or the VWAP to confirm trends. Um, this helps you avoid fighting the market and catch bigger moves. Breakout strategies. Enter trades when the price breaks the key levels and or support resistance levels. This signals a key potential strong move in that direction. Backtesting. Test your strategies using past market data to see how they would have performed in market conditions. Backtesting, test your strategies using past market data to see how they would have performed in different market conditions. This speeds up learning by showing what works before you risk real money. And of course, join a community. Join groups of experienced traders to learn from their successes and mistakes. This helps you avoid common pitfalls and shortcut your learning curve. I highly recommend joining a community because it'll help you get a point of view or perspective from other people, and it also helps you if you have questions or if you need help with something. You have people who were in the same shoes as you or people who are in the same shoes as you, and you can figure out something together. I do have a free Discord in my bio if you guys are interested. Of course, you don't have to join my community, there's plenty out there. But of course, I just highly recommend joining any community. Another way is to develop a deep understanding of a particular market or asset, or stay consistent with whatever edge you find and refine it over time. What I mean by this is stick with whatever you pick with. Um, It'll help you get better as you go, and it'll help you master something instead of just strategy hopping or trying to find something that really works. If you just journal and paper trade one strategy, and if you just refine it, work with it, tweak it, and make it perfect for you, you can really have something that's particular to you and you can find your own edge. And this is how all successful traders win in the market. All right, technical analysis. Technical analysis is a study of past market data, primarily price and volume, to predict future price movements. It uses charts and indicators to look for patterns and trends, helping traders make decisions based on how a stock or asset has behaved in the past. Instead of focusing on what a company does, technical analysis focuses on the numbers like prices, trends, and trading volumes to figure out where the market might move next. It's a tool to help you make educated guesses about the market's next steps. Remember, indicators work best when combined with price action analysis, support resistance, trend lines, and candlestick patterns. Don't overcomplicate your charts with too many indicators. Keep it simple and focused. Some common indicators include your moving averages, your RSI, or your moving average convergence divergence, which helps you identify changes in momentum. There's many out there. People all use many different ones, but please find what works best for you. My personal indicators are the 9 EMA, which is the 9 exponential moving average, VWAP, which is the volume weighted price average, and the 20, 50, 200 SMA, which is the simple moving average. The 9 EMA shows the average price of a stock over the last 9 periods, but it gives more weight to recent prices. This makes it react faster to price changes. You can use it to spot short-term trends. When the price is above the 9 EMA, it's often a buy signal, and when it's below, it's often a sell signal. The VWAP shows the average price of a stock has traded throughout the day, weighted by volume. It helps identify the true average price and is often used to spot key levels of support or resistance. If the price is above the VWAP, the trend is bullish, and if it's below, the trend is bearish. The SMA is just the average of a stock over a specific number of periods, like 50 or 200 days. It's slower to react than the 9 EMA, but shows longer term trends. Swing traders use the SMA to identify support slash resistance levels or confirm the overall market trend before entering a trade. All right, before you start trading options, you need to pick a broker. A broker is a platform that lets you buy and sell options. Some popular ones include Robinhood, Webull, and TD Ameritrade. Robinhood is for beginners. Its user-friendly interface is easy. It's commission-free, and it has instant deposit access for trading. Some cons are limited advanced tools for complex strategies, history of outages during volatile trading periods, and minimal educational content for options trading, which I think they kind of fixed, but the charts are garbage. So if you are trading on your phone, I do not recommend Robinhood. Webull, it's more of an intermediate trading interface, commission-free trading options as well. It has advanced charting tools for technical analysis and extended trading hours, pre and aftermarket, and it's easy to use for your mobile and desktop devices. Some cons are there's no direct phone support, so you cannot get help from a direct person unless you email. And there's limited educational resources on the app, but it's also pretty easy to guide around, and it also teaches you a little bit on how to use the app. Um, Advanced would be TD Ameritrade. If you are a beginner, I do not recommend this app because the interface is highly confusing for new people, and you will see a lot of stuff you don't understand, and it might be too much for a new trader to take in. Um, but is the best in class for options trading. It's highly educational and it's highly customizable as well. Some cons are that the commission fees for non-standard options trade and it's overwhelming. Now we have terms and definitions. We have strike price, the price at which you buy or sell a stock. With an option, knowing the strike price helps determine the potential profitability of the trade. We have the premium, the cost of buying an option. Understanding premiums is an essential for calculating risk and reward. You have your expiration date, the last day the option is valid, important for your timing your trades and knowing when your option will expire. And the bid and ask spread, the difference between the highest buyers are willing to pay and the lowest sellers are asking, which is the ask. A smaller spread means better liquidity, making it easier to enter or exit a trade. So I know that was all confusing, but I'm going to try to go over this in the most simple way possible. A call option is betting if the stock is going to go up. A put is betting if the stock option is going to go down. The strike price is where we believe the stock will end up at. If we are betting on Tesla to go up and the price is currently $300, we can get a Tesla 310 call, which is a 310 strike price. The strike price is basically the amount we think the stock or asset is going to go to. The premium is how much we pay for the contract. Each contract has 100 shares in it, so the premium is basically how much you are going to pay for the contract. The expiration date is when your contracts expire. If your stock or option does not meet the required strike price in a certain time frame, aka the expiration date, you either lose money or you can make money. A bid and ask spread is basically the sellers selling what they want their contracts for, aka the ask, and the buyers bidding on how much they want to pay for a contract, aka the bid. I will show you what this looks like right now. These are So this is what it's going to look like when you are buying your options. These are going to be your strike prices right here. We have our expiration date right here. And then we also have our premiums, which tend to be right here, aka our bid and ask spread. So this right here, our bid, is how much we can buy the contracts for. If we have the contracts already, this is how much we can sell them for. Does that make sense? Now we have some more terms and definitions like in the money, out the money, delta, and theta. In the money is basically when the option has intrinsic value and the price is above the strike price for calls. In the money options are important because they are more likely to be profitable. Out the money is when the option has no intrinsic value, stock price is below the strike price for calls, and out the money options are cheaper but riskier, often used for speculative plays. So in the money is basically when the stock goes above your strike price and you are basically over the strike price, you are making money. And out the money is when the stock is below your strike price. Basically, you're losing money or the contracts tend to be cheaper. Delta and theta are Greeks, and delta is a measure of how much the options price will change with a dollar move in the stock. Knowing delta helps you gauge the option's sensitivity to price changes. And theta, the rate at which an option loses value as it nears expiration, critical for understanding the time decay of your options. All right, we have implied volatility, break even price, open interest, and exercise. Implied volatility is a measure of expected future price swings in the stock. High implied volatility can mean higher premiums, but also greater risk. The break even price is the stock price needed at expiration to avoid a loss. Knowing your break even helps you assess if the trade is worth it. Open interest, the total number of outstanding option contracts for a specific strike price and expiration. It's important for gauging market activity and liquidity in an options trade. And of course, exercise, using the right to buy or sell the stock at the strike price. And it's important to know when to exercise or let the option expire based on profitability. So exercise is basically selling, not trying to make it complicated on you guys. Duh. All right, the Greeks. Delta measures how much the options price will change when the price of the underlying stock changes. Gamma measures the rate of changes of delta, and theta tells you how much the options price will decrease as time passes. This is also known as time decay. And Vega measures how much the options price will change with changes in implied volatility. And Rho measures how much the options price will change with changes in interest rates. All right, lastly, let's touch on implied volatility. It's a measure of how much the market expects the price of an asset to fluctuate in the future. Higher implied volatility usually means higher option premiums because there's a greater chance of larger price moves. Lower implied volatility typically means cheaper options. Understanding implied volatility can help you decide when it's a good time to enter a trade. For example, if you're buying options, you might want to look for low implied volatility because it means cheaper premiums. All right. Finally, let's pick a strategy. Some I like are opening range break, bull flags and wedges, support and resistance, and news. Opening range break is when you trade on the high or low of the first 15 to 30 minutes of the market open. If the price breaks above the range, you buy, and if it breaks below, you sell. Bull flags and wedges is a pattern where the price moves up sharply, then pulls back slightly, looking like a flag on a pole. You buy when the price breaks out of the flag, expecting another move up. Support and resistance. Support is where the price tends to stop falling, and resistance is where it stops rising. You buy near support and you sell near resistance to catch reversals. And of course, news, my favorite way to trade because nothing, no strategy, no price action, or no pattern will beat news. Um, if something bad happens in the market or in the economy, stock will go down. If something good happens, it will go up. News-based trading is the best way to trade because the stock moves based on news. News creates big price movements like earnings reports or economic updates. Trade by reacting to positive or negative news, buying on good, and shorting on bad. This is how I catch high percentage trades because usually that's where high percentage moves comes from. It's not going to be those short little scalps where I move $5, but I'm trading off what happened and why the stock moved up $30, if that makes sense. All right, here are my socials. I have Instagram at Paid by Stocks. I have TikTok at Paid by Stocks. My WAP and Discord you can find on verbandtrading.com. My Discord is free. You can join my WAP for free as well. And I also have a Twitter or X, aka Paid by Stocks. Um, I appreciate you guys watching this whole video. I hope you found something helpful in getting a strong foundation in options trading. Remember, it's all about learning, practicing, and refining your strategies over time. If you have any questions, drop them in the comments below. Don't forget that like and subscribe button for more content like this. I'm blessed to educate everyone, and I'm thankful. So I appreciate all of you guys, and if you guys have any questions at all, you guys can message me on any platform, and I'll respond. Have a great day.